Hello fellow intelligent investors. Today I want to discuss the idea of a best ideas fund. That term was originally coined by Charlie Munger, who had discussed this concept at some daily journal annual meetings. And it essentially describes the idea of asking a bunch of professional investment analysts, the best in the world, for their single highest conviction stock idea. And based on this, creating a best ideas fund in the hope of generating alpha, so beating the market. And I've come across a new best ideas fund on Twitter, as the user IQ, or invest quotes, asked 23 somewhat famous investors to name their highest conviction holding. I will get into the details of this later in the video, but let me say this here. I think the idea might sound very promising, but I think the concept of a best ideas fund is destined to fail. And you will learn why that's the case in this video. So without further ado, let's get started. Okay, so let's get right into it. In the intro, I already briefly defined the term best ideas fund. I think the term was coined by Charlie Munger, who has discussed this concept during, I think, 1 or 2 daily journal shareholder meetings. And when Munger spoke of best ideas funds and criticized them, he referenced Capital Group, which is basically a large LA-based fund manager that has been around for, I think, almost 100 years and has now more than $2 trillion in assets under management. And just like any other fund management firm that manages such a large amount of money, Capital Group has a number of different funds that they offer to their clients. And basically they assign teams to manage a specific fund, and each manager will, for example, manage a certain amount of money in their individual portfolio, depending on their experience, skill level and expertise, and maybe many other factors as well. Now, according to Munger, Capital Group once had the idea to ask all of their different fund managers for their single best stock idea in their portfolio. And they collected all the different managers' highest conviction picks, and based on that they have set up a best ideas fund. And obviously basic logic would lead you to believe that such a fund, comprised of the best ideas of some of the smartest investors in the world, would lead to world-class returns, right? Now, I actually couldn't find out when Capital Group launched these best ideas fund, but as the title of the video implies, I recently came across a similar idea on Twitter. In July of this year, the user IQ interviewed 23 different investors that are somewhat famous in the Twitter universe. And he asked them to share their single best stock idea and to share a short pitch that points out the key pillars of their investment thesis. And then he bundled these ideas in a thread. A big shout out to IQ here, who you can find under the Twitter handle Invest Quotes. I can imagine reaching out to all of these people and interviewing them was quite a time commitment, so maybe go give him a follow. And I would assume that you are probably familiar with, most of the highest conviction stock ideas that were mentioned in that Twitter thread. For instance, most of you are probably aware of businesses such as Facebook, Tesla, Nvidia, Peloton or Fiverr. But there were also a few lesser known companies that you might not have heard of, such as C Limited, Evolution Gaming or GoodRx Holdings. Now, Invest Quotes actually provided some interesting additional data points. For example, how often each idea was mentioned, because some of the ideas were mentioned more than once. Whether the ideas were part of the small, mid, big or mega cap universe. Where these firms are headquartered or the industry they are operating in. And then another big FinTwit user who I've actually quoted in quite a few of my videos, Brian Feroldi. He replied to that thread and wrote, "Pretty sure a portfolio of these stocks would crush the market." Essentially, Feroldi is proposing the idea that a best ideas fund based on this selection of stocks would outperform major benchmarks like the Dow Jones or the S&P 500, and probably by a big margin. And here's where I would strongly disagree actually, and where this video gets really interesting. So please stay tuned, and by the way, hit the like button if you want to support me, and then you might also get recommended more of my videos in the future. Thanks. So overall, this whole idea of a best ideas fund appears to be quite an attractive proposition for investors, I would think, because basic logic would dictate that a fund that is comprised of the best ideas of the best investors in the world would lead to Hall of Fame returns. Well, let's listen to Charlie Munger himself and let him explain how the aforementioned Best Ideas Fund of Capital Group has performed.
Let me give you an interesting example. In the investment world, it involves an enormous amount of high IQ people trying to be more skillful than normal. You can hardly imagine another activity that gets so much attention. And weird things have happened. And years ago, one of our local investment counseling shops, a very big one, they were looking for a way to get an advantage over other investment counseling shops. And they reasoned as follows. We've got all these brilliant young people from Wharton and Harvard and so forth, and they work so hard trying to understand business and market trends and everything else. And if we just ask each one of our most brilliant men for their single best idea, then created a formula with this collection of best ideas, we would outperform averages by a big amount. And that seemed plausible to them because they were ill-educated. That's what happens when you go to Harvard and Wharton. And so they tried it out, and of course it failed utterly. So they tried it again, and it failed utterly, and they tried it a third time, and it also failed. This counseling shop was looking for the equivalent of turning lead into gold, and of course it didn't work. I could have told them, but they didn't ask me. Now, the interesting thing about this situation is that this is a very intelligent group of people that's come from all over the world. You've even got a lot of bright people from China, where people tend to average out a little smarter. And the issue is very simple. It's a simple question. Why did that plausible idea fail? Just think about it for a minute. You've all been to fancy educational institutions. I'll bet you there's hardly one in the audience who knows why that thing failed. That's a pretty ridiculous demonstration I'm making. How can you not know that? It's one of the main activity of America. It's an obvious and important failure. Surely we can explain it. If you ask that question at a Department of Finance, at a leading place, the professors wouldn't answer it right. Now I'm going to leave you that question because I want you perplexed. And now we'll go on to another issue.
So, there you have the question that is the entire premise of this video. Why did that plausible idea of setting up a Best Ideas Fund fail? And why would a Best Ideas Fund based on the highest conviction picks of very smart Twitter users likely also fail? Just like Munger, I think it's worth taking your time thinking about this question. Feel free to pause the video for a second and let's see if you can come up with some explanations. And make sure to share your ideas in the comments down below. Well, I think there are 4 reasons why these Best Ideas Funds fail. And the last one might actually be the most interesting explanation. So the first one that I want to present here is diversification. In previous videos, I have discussed why investors who desire to outperform the market need to run a somewhat highly concentrated portfolio as opposed to an over-diversified portfolio. And I referenced actually various studies that illustrated just how quickly most of the benefits of diversification can be achieved. For example, one of the studies showed that about 90% of the maximum benefit of diversification, which is mainly reduced volatility, was actually derived from portfolios of just 12 to 18 stocks. And a pretty small number of stocks also diversifies away a large part of idiosyncratic risk, so company-specific risk, leaving portfolios with just systemic risk, also known as market risk, which you basically cannot diversify away anyway or avoid if you are active in the stock market. So once you get to around 10 to 15 holdings, much of the diversifiable risk is already mitigated. And at 20 stocks, the vast majority of idiosyncratic risk has basically been diversified out of investors' portfolios. And I think this is very nicely illustrated in the graph that I show you on the screen right now. And obviously, Charlie Munger himself is aware of this as well. He's famously quoted saying, "The idea of excessive diversification is madness. Wide diversification, which necessarily includes investment in mediocre businesses, only guarantees ordinary results. And that's what would happen in a best ideas fund. The more holdings you have in a portfolio, the harder it gets to outperform. And I think the Dow Jones is actually a great example to illustrate this, because it is comprised of just 30 companies, which are actually also operating in very different industries. But the Dow Jones performance over the last couple of decades is practically indistinguishable from owning the entire US stock market. Now let's say you have 30 fund managers coming up with their best stock ideas, and you build an equally weighted portfolio of their best ideas. I think your odds of outperforming a benchmark index by a wide margin are very slim. That's just the nature of diversification. So to wrap up this first aspect, I think investors benefit from moderate diversification, yet over-diversification will likely be a distraction and dilute their returns. The overall diversification will likely get you average returns. Now, to be fair, in the thread that the user IQ put together, he came up with a list of 18 stocks in total. And I think a portfolio of 18 stocks is certainly concentrated enough to offer a good chance of actually outperforming the market. So I think there must be other explanations that I will get to in a second. But before I get to my second point and explanation, I just wanted to highlight that the term best idea is widely used in the investment fund world. Just look at these funds that use the term best idea for marketing purposes. And I particularly liked the following one that is claiming to run, quote, a global equity best ideas portfolio that offers broad diversification within a genuinely global context. And if you think about this, I think this is absolute marketing BS. A best ideas portfolio on the one hand and diversification on the other hand. I think someone is clearly trying to fool you here and making use of marketing buzzwords. Another explanation why the best ideas fund concept doesn't work is related to one of the most critical skills in investing: patience. In my view, you can only beat the market if you can sit still for a long period of time until eventually a no-brainer opportunity presents itself. The problem of a best ideas fund is that you are basically forcing the so-called idea givers to present their highest conviction ideas in that exact moment of time. But what if there are no attractive investments right now that pass your hurdle rate, so the rate of return that you want to achieve? Buffett's best idea at the top of the market in 1968 was actually to get out of the market. And similarly, his best idea during the craze of the late 1990s and the dot-com bubble was essentially to sit on the sidelines and wait. And what's Buffett's best idea right now in 2021? Well, if you would ask him for his best idea right now, I think he would likely say that he doesn't have any very good ideas that pass his hurdle rate. And he has already lowered his hurdle rate quite significantly as Berkshire has become so large. Most likely his best idea right now is actually buying back Berkshire stock. So the way a best ideas fund is set up, you cannot be patient. You cannot be what Monish Prabrai calls be unreasonable. Let's just listen to him for a second and how he describes the art of being unreasonable and patient.
Eli Broad talks about the art of being unreasonable. That's the title of his book. It's a great book, actually. And so Broad is a very successful entrepreneur. And so in the quest for investments, be unreasonable. So don't settle for, this thing is at 13 and it should be 18 and that sort of thing. I always tell people, please try to send me things which are PE of 1, because PE of 1 is great. Maybe PE of 2, and I can deal with that. Single-digit math is easier to deal with.
And again, if we look at the collection of the highest conviction FinTwit stocks, how likely do you think it is that all of these 18 ideas trade at attractive valuations, at amazing bargain prices? You would make 18 investments all at once. I think that's impossible. If you are truly unreasonable, you will likely only make maybe 1, 2, or 3 investments per year, depending on the opportunities Mr. Market prevents or provides. But not 18, all in one exact moment. I think this second explanation intuitively makes a lot of sense, right? But it's only part of the answer why these best idea funds fail. And I would like to add a third explanation here. If we go back to the Capital Group Best Ideas Funds structure, well, then we will notice that some of the fund managers were sector or industry experts, specialists. So for example, the oil and gas analyst would choose the best oil and gas stock. The healthcare expert would pick the best healthcare stock, and so on and so forth. And what this setup fails to acknowledge, and please pay attention now because this is so important, it fails to acknowledge that selecting the best companies from each sector is vastly different to simply selecting the best overall stock idea. The fourth best idea from one sector might provide better future returns than the best idea from another sector. Put differently, the highest conviction stock idea of one manager will appear attractive to this manager on a relative basis, relative to all the other stocks in that sector, but not necessarily it might not necessarily be the most attractive idea on an absolute basis. So what Capital Group originally thought to be a source of alpha turned actually out to be a major limitation of this best ideas fund setup. Now if we focus on the Twitter-based best ideas fund, we have to say that in all fairness, this is not necessarily a limitation here. Depending on how broadly you distinguish between different industries or sectors, you could make the case that many of the mentioned stocks in that Twitter thread actually operate in very similar sectors or industries. All right, the fourth and final reason why a best ideas fund setup will likely not work are psychological biases. And one bias that Charlie Munger put forward to explain the poor performance of Capital Group's Best Ideas Fund is the commitment or consistency bias. Our bias towards commitment and consistency makes it difficult to change our mind, even if we are wrong. And that's why the idea that managers had spent the most research time on was typically their best idea. And this is actually one of the explanations that Munger himself articulated during a private interview following the 2017 Daily Journal shareholder meeting. Let's just hear what he had to say.
Oh, and there's another experiment they've done about three times at Capital Guardian. Follow what the great investors are doing. That's one way. They said, we'll get the best idea from our best people and we'll make a portfolio just of our best ideas from our best people. Nothing can be more plausible. They've done it 3 times and it's failed every time. Now, how would you predict that? Well, I can predict it because I know psychology. When you pound out an idea as a good idea, you're pounding it in. So by asking people for their best ideas, they were getting the stuff that people had most pounded in, so they believed. So of course it didn't work, and they stopped doing it because it didn't work. They didn't know why it didn't work because they haven't read the psychology books, but they knew it didn't work, so they stopped. And it's so plausible. I don't think that's true at Berkshire. I think at Berkshire, if you asked me and Warren for our best ideas, that would have worked. But it didn't work in a place like that. A more conventional manager. By the way, I don't think it would work that perfectly at Berkshire. I think it would work better than it did at Capital Guardian.
So when dealing with commitment and consistency bias, you have to be careful because it's a very fine line you have to walk here. As I've outlined in my last video, on the one hand, you cannot invest in a stock until you have spent a good amount of time studying the business. That's the only way to build conviction. But on the other hand, if you spend too much time studying a company, you might become biased and feel like now that you've committed so much time, energy, and effort, your idea has to work out. So intense research is important, but it can only partly mitigate risk and might in fact increase risk if you become overconfident in your idea. So the best investors in the world, they are able to spend a lot of time and energy on one idea, but they are also still able to walk away from that idea if they notice that they might have been wrong initially. So I certainly hope that if someone just bought all of the stocks recommended in that Twitter thread, I hope that he or she does well financially. Maybe we should track the price quote actually on the day of that Twitter thread. So that was July 21st, if I remember correctly. And then let's see if a portfolio of these stocks that is equally weighted can outperform the S&P over a 10-year period. I think I have very clearly expressed that I have my doubts, but I could just as well be wrong about this. So yeah, let's just wait and see. Some of the stocks mentioned in that Twitter thread will likely outperform standard benchmark indices. But I think a collective best ideas fund comprised of 18 best ideas is not going to work. And let me know if you agree with my assessment here in the comments down below. And now lastly, I think what's also important to point out here is that picking the right stocks is only one part of the investing process. Another piece is portfolio construction and management. So how do you size the positions? Have you considered potential correlations between your holdings? Do you make use of hedging strategies? Do you ever add, trim or sell to your positions? And so on and so forth. And thus, even if two investors could successfully outsource the idea generation process, they will likely achieve very different results. And I think with that, we can wrap it up here. And as always, may your finances and investments prosper. Good luck.